the two things I think will, or one of two things that will probably end this bull run that we've kind of been on, the bullishness that we've seen, and I think the first one's going to be unemployment, and unemployment, yeah, unemployment rate. So there you go. So there's the unemployment rate. Now we know that we're like historically low unemployment rate type levels, and typically whenever you get down to these type of levels, well, I mean, you're gonna get the move back to a higher level of unemployment. Like that's kind of how the way it works. We know that it's been historical, just how the numbers games works, right? So, but the Fed, the market, a lot of economists just say basically anything under 5% is considered full employment, and we still got like about a 1% move, a 1.1% move back to that 5% level. Now, the thing that could spur unemployment to go higher, well, would be layoffs. And the area where I think layoffs probably would happen and come from would be AI. And there's been a lot of CEOs and big timers in the AI space that are basically saying like, hey, AI is going to basically take some jobs. And this is one headline over the NVIDIA CEO Jensen says kids shouldn't learn to code because, well, they should leave it up to AI. And not to say that AI coding is perfect, but once it continues to kind of get better and continue to get better, then it's going to be very hard to keep software coders and developers around. Here's him. This is another article, basically a month later at some different conference, basically saying the same thing. Just leave programming up to AI. Here's one with Sam Altman, OpenAI, basically CEO, saying coding will go away. So that's that's two bigger wigs in the space, basically saying, yeah, coding's probably not going to be around much longer as like a profession. And then we're even seeing businesses already kind of do that, where this headline: layoff in 7-minute meeting, IT giant replaced 30% roles with AI. This is basically IBM. IBM did this. IBM has continued to do this, and they're probably not the only one. They're just probably the bigger one kind of doing it. That's doing it more rapid than others. We'll see if that was the smart move to do it as rapid as they did. But and then here is another article: new AI assistant threatens software engineering jobs. And this was actually a pretty interesting read. I don't fully understand all of it because I've never really done software engineering type of roles, but apparently this AI Devin basically does the entire collaborative process with the users during the software development. And that's a big deal because that's not even just coders, but that's like, project managers. He gives you progress updates, the feedback, and then it's also the middleman between the end user and the people that want the product and those that are making the product. And like they are the middle person that's kind of going in between. So that's like not just software development, that's also being threatened by AI. And so if we continue to see AI take jobs, and not even just take jobs, but don't even provide really high, like just stops hiring for software development type people or coding or in that area, then all those people that thought they were going to go into that business, well, what are they going to do? And then that's where you can see the unemployment rate tick higher. And as AI continues to get better, you're going to continue to see layoffs. And that's probably a big reason why over the past year we have seen unemployment rise. How about that? When did AI really start being talked about? About a year ago, when NVIDIA introduced its H100 chips and everybody was ordering them. So what are going to be some of the other areas that AI is impacting? Well, this is a pretty good article here. Which job departments will AI impact the most? IT, the big one. Finance, another big one. Customer sales, operations, HR management, HR, marketing, legal, supply chain. So there's a lot of areas here that like AI is looking to impact, not just software development. So it'll be an interesting thing if unemployment continues to go higher in the market. What would the market do if we continue to rise here on unemployment? If we continue to see layoffs, Meta last year had quite a bit of layoffs last year, and they still making a lot of money. Why is that? Well, they're not having to pay all these software developers, right? Like that's a big part of their business is writing code to optimize, whatever they're doing on Meta's platform or all their different things like Facebook and Instagram, the VR stuff. So yeah, I mean, if you can cut costs and get rid of a $150,000 software developer, okay. If you can get rid of a few of those people and then have just one person manage the AI code and just make the fine tweaks that need to be made, okay. So this is where we'll probably see the unemployment rate probably continue higher, and it's probably going to come, from AI and that kind of area. So, anyways, another interesting thing about unemployment is, unemployment is, oh man, it's such a dynamic type of metric. But this was, when was this put out? This was not put out long ago. March 1st of 2024. So this is a new kind of chart, basically showing you where all of the different semiconductor plants are being built in the U.S. And it's a pretty interesting one, because over the next 2 to 3 years, we are going to have many of these projects wind up ending, which means all of the employment that is there to build out these different projects, these different foundries for semiconductor plants, are going to end. So all those jobs are then going to end. Okay? So this is going to be like another area that we're going to see potentially unemployment kind of continue to go higher in these type of businesses, like construction businesses. And so those are like the two main areas. I would say these semiconductor plants, once they're done and being built here over the next 3 years, most of these are going to be done in 3 years. There's a few others that are going to be done in about 4 years. And then all the AI jobs, or the AI that's taking or replacing jobs or doing jobs better. That way you don't have to hire somebody. So those are going to be the two areas as we continue to see semiconductor plants come online and in software jobs not being needed as much. Now, I would say if unemployment doesn't wind up ticking higher, which I think it will, that'll probably be the most likely case. I think the other one is going to wind up being the debt to GDP. Okay. Well, not debt to GDP, but let me talk about debt to GDP real quick. It's going to be yields. I want to get to that in here in a second. So we see that the debt to GDP is at all-time levels. It's higher than what it was back in World War II. And what's going to be interesting is what happens, well, when the GDP starts to drop, or what I actually think is happening, and it was probably what has happened over the past couple of decades, is the GDP number is not really a good reflection of like revenue into the government. And I think that's kind of what this was meant to look at before, is like, how much debt can you afford for your GDP? Because GDP is meant to be like, hey, how much do you produce? Because what you produce is what you can tax. And that's not entirely accurate. GDP is your production as a country. The way you tax money into the government is by payroll taxes, is by people paying taxes. That's the biggest part. That's the biggest part. Okay. There's also business taxes, sales tax, all that kind of stuff. But as far as into the federal government, it's payroll. It's payroll taxes. And what we've seen over the past couple decades is more automation. So we continue to see GDP, continue to be pretty strong, but we don't really see that reflected also in other metrics that don't continue to kind of continue up those kind of trajectories, like I would say like home prices versus pay increases. That would be a good one to look at. I'm not going to look at that, but that's one that hasn't kept up, and that's probably a big part of it, is because, well, I mean, businesses want to continue to reduce their expenses as much as possible, and the big one is biggest expense that basically every business has is people. So I do think that there probably needs to be a better way to kind of monitor, and the government probably has this data, but as far as like the public, we don't have this data. But a better way to kind of monitor the debt to income, because that's really what GDP is kind of meant to kind of replicate here. The GDP number is income, but we don't have that data, or I don't know of an easy way to really get it, I guess. But how is that going to really factor in when we talk about yields? This will be the interesting one, is how that will affect yields. Because if this market sniffs out that we don't like where the debt to GDP number is, or debt to whatever metric is, yields is a supply and demand function as much as it is on credibility, right? Lower the yields, the better your credibility. Higher the yields, the less your credibility, right? And that goes across businesses and stuff like that. But it's also a supply and demand thing, okay? If investors feel like that they can no longer trust the U.S. government to make future payoffs on its debt, then the investors will sell off debt assets, right? They will close out bond positions. And when they do that, it will send yields higher. That would be the interesting one, right? We haven't seen yields really kind of drop off. Everybody's been talking about, oh yeah, yields are going to go lower and all that kind of stuff. And we haven't really seen that. We've seen them come off the highs, from the October highs of 2023. We've seen them come down a little bit. And mostly that was in a 2-month move. Well, what if they start to climb back higher again? What if investors start to say, yeah, we don't trust U.S. debt in the future? Because it's going to come down to two things, right? If unemployment doesn't go up, it doesn't force a recession, then, the U.S. government's going to continue to print money, continue to drive up the debt. And then eventually you're faced with one of two things. Either you're faced with higher inflation than what you want, or you got to cut spending because your yields are going higher, and that is forcing so much of interest to be paid that you basically have to cut spending back to pay for your interest, which then hurts the economy because the yields, by cutting spending, would then force the market into a recession, or the economy into a recession. So those are going to be the two areas that I kind of see it ending. The better scenario, honestly, is going to be unemployment rising, because if the debt market and the bond market send yields higher, and we see a reduction of investors buying and holding U.S. government bonds, if the debt market sends the economy into a recession by increasing yields, then that would be a pretty disastrous type of scenario, because you're basically then can't get yourself out of a funk, which has normally been the case in previous bear market, recessionary scenarios, where usually you use debt instruments to get yourself out of a recession. right? You issue debt to help stimulate the economy, and you wouldn't be able to do that because your yields would be so high, your interest payments would be so much higher, and that's the thing. You already have so much debt out there that you have to then pay. How do you pay off the already existing debt? Well, typically you issue debt and pay off the existing debt, which is why it's not good to have so much debt because once you got to pay the higher interest rate, now you have to issue more debt to pay the interest. So that's the two areas that I think that are probably going to end whatever bull market we're on, and yeah, I mean it's just going to come down to either unemployment or come down to yields. That's why I focus a lot on them, is because if unemployment goes higher, then we'll probably see the debt to GDP number go higher, which will then impact yields and that bond market to then go higher. As I don't think the bond investors are going to like very much that the debt to GDP number keeps going higher. But if the unemployment doesn't go higher, I think eventually the bond market and those investors are going to say, hey, enough's enough. We want a higher payoff for the risk of how much your debt to GDP is. And I think debt to GDP is a little bit outdated metric. I think it needs to be like debt to income, but I don't really know how the heck you calculate that, especially on the income side. I mean, there's probably is a way. I just don't know of it. But I mean, it is kind of concerning that we're not seeing yields continue to drop off like everybody has expected. Everybody expected, oh yeah, yields are going to drop off. Which let me even bring up this one. So this is basically BlackRock talking about the Fed's move after last week's FOMC meeting, right? Because this came out the next day, I believe. Yeah, Thursday. Fed's dovish pivot. Inertia may spell trouble for long-term bonds. I don't. It. I should maybe you should read the article, but I think really what they were kind of talking about was they expect um, bond yields to go down. That's what I thought they were mentioning. Okay, hold on. Let me see here. Longer term U.S. Treasuries could be vulnerable if the U.S. Reserve outlook on interest rate cuts is challenged by stubborn inflation. A portfolio manager at asset management giant BlackRock said on Thursday a majority of the Fed officials this week confirmed earlier forecasts for the central bank to deliver 3 interest rate cuts this year, despite stronger than expected growth, though only a thread. Should inflation remain persistently strong, however, prices for intermediate and longer term bonds could suffer because they do not fully reflect a scenario in which the Fed is forced to keep rates higher for longer. David Rogold, portfolio manager of BlackRock's fundamental fixed income group, said in an interview. With all the heavy supply and a pretty robust economy, we don't have a term premium in the curve, Rogel said, referring to the premium. Yep, the premium, like we just got done talking about, premium investors ask for the risk of holding long term paper. For extending duration out that far on the yield curve, there should be more compensation. Okay, so I actually thought this article was going to go against kind of what I was saying, but it's actually speaking in favor of what I'm saying. Okay, or at least he Rogel is basically saying kind of the same thing I was saying, where there's no premium in the long term end of the yield curve, and let's see what the longer term is doing today. So we know that the 30-year has actually been stronger. It had a much stronger bounce to start the year here in January, and even when it came back, it had a much higher low from the end of December to the kind of beginning of February, I guess. But yeah, you can see the 30 years bouncing back, and that's basically what he's saying is if inflation. Now, I didn't even talk about inflation. I'm more of just talking about supply and demand and the risk premium is what I talked about. But he's talking about inflation. Like if inflation stays strong, we could see the market and bonds really kind of rise on the yield side, which would push the bond prices down, which would be the TLT basically, which would push the bond prices down, right? And so we would see the bond prices drop off, and then we would see yields go higher because they're inverse, and that would be an interesting scenario. It's one that we haven't. I mean, we haven't really seen a scenario like that in multiple decades. Like you got to go back to like the '60s, I believe, '60s, '70s. So that's basically what he's talking about. I didn't even talk about inflation, but I mean that could play into it very much so. And I mean I kind of did very briefly just because government spending is so high that it leads to inflation, but not in kind of the sense that he's thinking it's going to impact longer term bonds. I think it's just more of investors are going to get tired of getting ripped off, especially when inflation is going to be at like what was it, what did it come in this past time? I think it was 3.2%. Well, if it's at 3.2%, I mean you're barely getting anything over some of these longer term bonds. The 10 years paying you like 1% more right now. That's nothing. That's nothing. The market's giving you like 15% a year. you know, like why would I hold bonds? I mean, I get it. They're supposed to be safe, right? But yeah, it'll be interesting. It was interesting. It was interesting to me that their inflation forecast rose for 2024, but the policy rate expectation didn't change. Yeah, and that was what I thought was interesting too, Mr. Rogel. I think that just reflects the fact that the Fed has a bit of inertia on its dovish pivot, and I think if we get more bad data on inflation, they will have to adjust.